And like, if I think about running a company, like the amount of time it took those people to be 5% better or whatever the exact number was, which is pretty minuscule, like they're going to be far less successful. So I think team is the most important thing. And then we kind of look at product and market and analyze those two.
Hi, everyone, and welcome to another episode of Over the Wall. Today, we've got Joey Krug, the Chief Investment Officer of Pantera Capital. Pantera Capital is one of the largest asset managers in crypto. And Joey really shares his perspective on not only the industry, but individual investments and all the changes that are going on. Obviously, we're in a crypto winter, so I really wanted to understand what his perspective on that. We talked about DeFi protocols and Maker DAO and crypto regulation and really about the culture of crypto and really about what's the best way to make investments in this asset class. Obviously, they've done, I think it's about over 190 different investments in startups around crypto and other and investments in tokens. And so he's got the widest perspective, I think, and most in-depth perspective about this industry. He's one of the leaders in it. So I hope you enjoy this episode. Once again, I'm trying to really, over the last couple of shows, just give a little bit of an intro, a little bit of taste to crypto. I know many of you are innovators, you're entrepreneurs, you're probably interested, you may be already investing in it. But I figured I would introduce you to some experts who can help guide you as you get involved with crypto and other investments like crypto. Enjoy. Thanks. Hi, everyone. It's Robert Cassio again here on Over the Wall. And today I've got Joey Krug, the Chief Investment Officer of Pantera Capital, which is one of the largest asset managers in crypto Web3. And as you know, I've been doing a lot of interviews recently in this topic because I think it's really fascinating. Also, there's a tremendous amount of entrepreneurism going in this area. I know many of you are entrepreneurs and you're building businesses. Anytime someone comes to me and says, where should I become an entrepreneur? I go, look in crypto, develop something in Web3. Obviously, I started in the internet in 95, but I think it has that same vibe of all the new things. And I'm really excited to have Joey here because of the investments they do and what they're doing in crypto and Web3. Joey, welcome to the show.
Thanks for having me.
So, I wanted to kind of start. I usually like to start at the beginnings of and level set about, the perspective on crypto and obviously there's been a lot of negativity recently around it. What I wanted to start with, though, from your perspective is, I think everyone had a perspective. It's decentralized finance. It's truly DeFi. And we're seeing things like with Terra Luna and all these, we've seen some issues in the last couple of months with things that don't seem decentralized. I just want to get your perspective on that. And, it's supposed to be opposite to what we get in the normal financial world. But it seemed like there's a lot of things that are similar to the traditional finance world.
Sure. Yes. The way I think about that is like, if you look at the cryptocurrency space and smart contracts, they're very generic sorts of tools, right? And so like you can create a set of smart contracts that's completely decentralized end to end where, there's no point in it that has, any sort of control by any person. You can also write a smart contract that says, all the money goes directly to Rob, and then you trust Rob to do whatever he wants with the money. And then he can choose to distribute to anyone who's used this smart contract. And so it's just like kind of any other piece of software. It's pretty generic in terms of what you can do. And so one thing that's sort of been a problem in the space, I would say, is you sometimes have people say, we're building XYZ and it's 100% decentralized. But then like you actually look at their code and like it's not, right? Like they've added centralized components and sometimes those centralized components, don't really matter that much and it's not really that big of a risk. They just make it easier to use. The other times they actually add risk, like, the centralized component could steal your money. The centralized component, maybe it's a price feed. And if the price feed's wrong, maybe your trading position gets liquidated and it shouldn't have. And so like anything else, it's kind of a double-edged sword, I guess is how I describe it.
So how would you protect yourself? Because you're right, like most people don't have the capability to look at code. They're just putting money in to get a return. And so what, looking at, how would you kind of like figure it out if you were not so technical,
Yeah, so I think one thing, like if you're not super technical, the way I would think about it is if you look at the different DeFi protocols that are out there, there are some that have been around like for a very long time, where there aren't like a ton of active changes, happening to them all the time. One good example of this is something like Maker DAO. It's one of the first DeFi protocols that ever existed. Been around a very long time. They really like prioritize decentralization. Another example might be, if you're looking to like trade assets on chain, you could go to like some really, really new thing that just came out 2 months ago, or like you could use Uniswap, which has like been around for years, and again is you know pretty constrained in terms of like what it is, and in terms of in sense of like it's a set of smart contracts. There's not really any kind of like centralized choke point on it. Um, and as far as how you like figure it out as an end user, there's a couple things you can do. One is you can, Google and read about a project based on what people who are technical have written about it. Like if you Google Uniswap, like for instance, you could Google like Uniswap centralization and see what comes up. You'll probably see people saying that the website is centralized, but you shouldn't really see anybody saying that like the smart contracts, which is kind of like the keywords you're looking for, are centralized or have like centralized choke points, because they don't. I mean, you might, and that would be fake news. Um, and then the last thing you can do is like, say you're like still unsure. There's actually great like DeFi insurance that you can buy. It's like, say you've put money in Compound, which is a lending protocol, and say you're earning 5% a year on it. You can go to sites that will let you buy insurance for like 50 basis points a year, and your return now drops a little bit. It goes from 5% to 4.5%. But if Compound gets hacked, if something fails in Compound, it blows up for whatever reason, you can get your money back because the insurance contract will basically pay you out. And so that's kind of like a last fallback, where like even if you're unsure about everything else and have no idea what's going on technically, you can still always buy insurance for the stuff that, not always, some projects are so new they don't offer insurance, but usually you can find somewhere that to buy it for the major protocols.
So that's the way to sort of protect yourself and look at how you're going to protect yourself fully. That's the way to do it.
Mm-hmm.
And if it's a DAO, we talk about DAO. We've talked about a couple times DAOs here and truly decentralized organizations versus centralized. Maybe you can unpack that a little bit. Like you talked about Maker DAO and talk about like
Yeah.
what is that structure? What do you look for in that? How do you participate in that? As a normal user, uh, you know, voting rights, things like that.
Yeah, so like the way I think about DAOs in general, so the term is basically an acronym. It stands for Decentralized Autonomous Organization. Um, it's kind of a silly acronym. Like the way I would describe it, just like in a sentence, is like, they're basically a collection of smart contracts where people across the globe can interact in some sort of commerce, which is usually a financial commerce, and so it's usually some sort of market-based thing. And so if we use MakerDAO as an example, it's one of the first ones that was ever created. It's a set of smart contracts. The functionality at its core is pretty simple. We'll just go through Maker version 1 to keep it really simple. So Maker v1, you deposit Ether. You can borrow against your Ether. You're borrowing in what's called a stable coin, so it's a cryptocurrency pegged to the dollar. And say you borrow like a lot of money, and say the ETH, if the ETH price fell 50%, you would like owe more debt than money that you actually had. Well, the system has a way of dealing with that, which is as you start to get close to the point at which you would be under collateralized, say you're at like 120% collateral or something, the system will basically do what's called liquidate you. So it'll auction off your ETH, people will bid on it, and they'll basically pay back your debt, and they'll get your ETH as collateral. It's the same thing that happens like if your house, were to get foreclosed on because you took out some massive mortgage on it, and then the housing market collapsed, 30 or 40%. And so, but it's like with crypto assets, the same thing happens in the stock market. If people have heard of like margin trading, it's kind of the same thing. Maker's basically a system that allows you to borrow against your Ether on margin. And there's a few different things you can do in Maker. Like one is like that core set of functionality, but there's also like parameters and things that need to be decided on. Like for instance, I mentioned a collateral ratio. Like, should Maker be really aggressive and only liquidate you when you have like, 5% more capital than you need to be underwater? Or should it be very conservative and liquidate you when you're, when you only have 140%? It's like it's a pretty conservative approach there. And these sorts of things are decided on by the end users, which is why it's like called a DAO. And I guess the last thing I would say on this is the way those decisions get made is people who own a Maker token basically have voting rights in this DAO. and it's one token, one vote. So like if you own 100 Maker tokens, your vote is weighted, 100 times the amount of someone who only has one. And you might vote on these parameters. You might say, well, I think Maker's being way too aggressive these days. I don't actually believe that, but say I think it's being way too aggressive and I want to raise the collateral ratio. So I might, make a proposal to vote on that. People would vote on it, and then it actually would get updated on chain when that happened.
So yeah, so it's basically the community is deciding the future of the business, shall we say, or in this case, the protocol. So they're deciding on it. It's not one person or a centralized group or a board of directors. It's basically the community and people who have invested in the protocol. So it's a much different thing. There's this vision that I think that we all think that the future of companies is this. But once again, I go back to the recent bruising of what's happened in the industry. I feel like, do you think it's a setback to this concept of decentralization, or look at just cleaning out all the BS that was out there, and now we're going forward with a more stronger group of companies or decentralized organizations?
Yeah, I mean, I think like my view is that I don't trying to think how I describe it. Like I think if you think about like DAOs in general, they're basically like really glorified like shareholder governance in a sense. But because they're software, the shareholders can vote on a lot more things than regular shareholders can. Right? Like if you're voting like if you own like Apple stock, maybe you vote like once, a quarter for their board meeting or whatever, and the vote's kind of like a
Once a year,
preset selective.
yeah, yeah,
Yeah, once a year, I guess. See, I don't even know. I don't even own Apple stock. And so you vote once a year, and there's like a selection of things that the board's kind of already put up for the vote. If you gather a group of shareholders together, you can somehow via some process get something added to the list, but it's kind of a pain. Um, in crypto, anyone can make a proposal to add something to like the slate of things to vote to. If enough people like say, hey, I think we should actually vote on this, you could then like trigger people to actually vote on it. And then like the voting happens, the decision gets made, and then it gets implemented. And the reason is these organizations are inherently like software based organizations. Like if you look at Apple, it involves so many things beyond just software. There's the hardware, there's the manufacturers, there's marketing, sales. Um, for something like MakerDAO, yeah, there is some element of like marketing to it for sure. Um, but most of it is purely software. And so DAOs are really good at making like decisions around like, what should a certain parameter be. They're not like visionary though, right? Like it's not the future of companies in that sense, but I would say it's probably the future of like shareholder governance.
gotcha. So you're 27 years old, from what I've calculated, and you're chief investment officer of I think it's 5 billion assets, is my understanding, maybe more or less depending on where you are,
A
but
little bit
it's a
less.
big number. Okay, a little bit less now, yeah, but it's a big number, and so obviously that's a big responsibility. I guess a couple questions around that. One is, how do you look at risk, and what tools are you using, or is there one thing that you look for from a signal perspective of risk? And right now in the market, obviously in the last year, you've probably seen a lot happen, and I don't know if you're hedging against your positions, and how are you dealing with the massive volatility that's happening in the market as a CIO?
Yeah, so I'd say at Pantera we're generally like fairly net long, just because like a lot of, if you look at our LP base, it's mostly people who really want exposure to crypto. I think long term, like as the space evolves, like we'll start doing more kind of like long short style stuff eventually, but it's just people don't have that large a portion of their portfolios in it yet, for that to be kind of the strategy that people want. But we do things like trade risk around. So an example of that is like if you look at the market environment over the last year, we took a position last summer that we were pretty bearish on DeFi versus ETH. Over the next 5 years, I think DeFi is like going to drastically, change the way finance works. But short term versus ETH, I think it's going to underperform, and it has over the last year. I think that underperformance probably continues for a bit. And so we don't have a lot of DeFi exposure right now. If you look at like ETH, we've traded around ETH versus Bitcoin, just trading that trading pair, trying to capture some alpha on that. We don't do that much like, ETH slash Bitcoin versus cash style trading though. Mostly just because like one, the risk if you're wrong is very high. Like there's days where crypto goes down 20%, there's days where it goes up 20%. And I forget the stat, but it's like the classic, you missed the 5 best days in the market stat. Like your performance is really bad. And it's been a while since I've done the math on that in crypto, but it's even more extreme than it is if you're trading like Apple stock or whatever.
And so when you look at the markets today, I guess, do you think they go they're going to be worse than they are today? Like ETH, Bitcoin, everything's going south, or today we hit about 18,000 at the beginning of the day. We're up to 19,000 on Bitcoin, obviously, but it needs, I think it's about 1,500. But what's your sense of where we are right now? In the market.
Yeah, I mean, I think like right now in the market you have kind of three things that are at play. One is you have the Ethereum merge happening, mid-September, which is going to be very positive from like a supply standpoint. There's much lower supply going to the market on a daily basis once that happens. Then you have what's going on with like interest rates and inflation, um, and then the last piece you have is like trend and sentiment. Like what's the sentiment around the crypto market? And so I think like my view, if you kind of like synthesize all of those, is like merge is very positive. Inflation is trending in the right direction, but Russia shutting off the gas pipeline to Europe could be a black swan event that really messes it up come winter if it's still off. And then trend and sentiment. Right now, there's actually not really a super clear trend in the market. Starting in kind of late June or late July, the market kind of regained trend. We went from $1,200 ETH to like $1,900 ETH. Right now, kind of most of the trend stuff that I'm looking at, shows that like current trend, like if we're above 1,600, we're in an uptrend, and if we're below 1,600, we're in a downtrend. Like that's on like a daily time horizon. It's like that, by the time this gets published, like that could have
That'll be
changed
yeah,
already.
exactly. Yeah. Yeah. And then you guys are also investing in early stage crypto companies, Web3 companies. Give me a perspective on, how you're making those investments, and then tell me like your best and worst in it. What have you learned investing in these companies? And I think you got about 100 investments or 190, depending on how you count it, between coins and actual investing
Right.
directly into the companies. But, what's kind of like your perspective on how you do that? And then what's your best and worst that you've done so far in your mind?
Yeah, so I'd say what we look for is like, I think the most important thing, it's not anything novel. The most important thing is like team, and like basically if you look at team, it's like kind of like how like perseverant and relentless are they? Like are they people who never give up, or do they give up very easily if something is going wrong? Like are they the type of people who kind of like defer responsibility, or the type of people who like just kind of like the way I describe it's like if you see like a nail out of place, do you like pick up the hammer and knock it back in, or do you kind of say, hey everyone, there's a nail out of place? And the last group of people are very bad founders. You want the group in the former to just fix the nail and move on.
Yeah, fix things.
um
Yeah.
yeah, basically people who can fix things and move fast, and also people who can make decisions like pretty quickly without a ton of information. um, there's actually a really interesting study on this that is like an academic study that came out a few months ago, and it was like, I forget the title, but it was something fairly misleading. It was like people who take a long time to make decisions and consider lots of information, um, are like superior to those who make decisions quickly with kind of the information they have at the time. But then if you look at the actual data behind the study, which I found was fascinating, they were like 5% better. And like if I think about running a company, like the amount of time it took those people to be 5% better, or whatever the exact number was, which is pretty minuscule, like they're going to be far less successful. So I think team is the most important thing, and then we kind of look at product and market and analyze those two.
What are the like?
Go ahead.
What's the investment you're most proud of? Yeah. And then the one you're like, maybe not so good, but maybe it's got a future.
Yeah, I mean, I think like best investments we've made, there's kind of like two that come to mind off the top of my head. One of them is called Alchemy. So it's basically a way that makes it really easy to run Ethereum nodes. We invested in their Series A. Actually, with the one of the projects I started, Augur, we were actually their first customer. And so that's how I realized it was a good product. Um, and then the other one is Near, which is the layer one blockchain. Just like from a return multiple standpoint, both of those have been really really strong for us. And both of them have really good they meet the criteria I just listed on the team side. Um, I'd say like, you know, w- worst is like probably not really on the private side, but more just like, you know, like there's not like I guess what I describe is like it's like there's that one quote that's like, I forget the quote. Basically, like what I would say is like, all, all bad investments like they kind of like have like the same handful of traits. Like they're like, it basically comes down to like the team either wasn't great or the market just didn't work. And in cases where the team wasn't great, that's something you can kind of take and learn from and figure out like what did I diagnose wrong on the team that like I shouldn't have backed them. And then on the market side, a lot of the time there, it's just like you made a plus EV bet and the market didn't show up. It's like the market recent quote about how like, you know, good team meets, bad market wins, great team meets great market wins. The market kind of drives a lot of it, I would say. So there's not really any one in particular that I would say is like I really made a bad decision investing in that one. It's more kind of like there's like a collection of ones that meet those two criteria.
Is there like a trade you made that you would then say was like one of your worst trades that you made in the history in your while you were here?
Yeah. So I keep a list of like all major investing mistakes I've made. I would say trading wise, the I think like the biggest mistakes I've made when it comes to trading are basically in like two categories. One is like taking risk off too soon, and the other is not taking risk off soon enough. And so like there's an example where we had this position, Matic, which is like a scalability layer two on top of Ethereum, and we bought it at some point in 2020, I think. And then the price is basically flat for like the longest time, and eventually I kind of said, look, like it's been trending flat for a while. There doesn't really seem to be that much market positive sentiment around it. Let's just sell it and buy ETH or something. We did that, and sure enough, like 6 weeks after that, like market sentiment shifted rapidly, and then like it kind of started going back up from a price action standpoint. And the mistake wasn't selling it. The mistake was not buying it back once that those two things that were the reason I had sold it had changed. And then like the asset ran up like 50x, after that point. And so that was like probably I'd say my biggest like trading mistake.
Did it come back down, or is it holding up? Curious.
It's come back down some, but it's still way up versus
Sure.
versus when we sold it.
What changed the? That's interesting. Like, what changed the sentiment on it? What happened that triggered a more positive sentiment on that coin?
Um, I don't like I think like part of it was just like the narrative around layer twos started to shift. Um, like people started talking about how they were really interested in layer twos and like scaling, and I think that was kind of the main shift there.
I assume you invested in Terra Luna, and I'm curious, like, how did that hit you guys hard with the collapse of it, and did that leave any perspective on you know how you want to invest going forward? Another lesson learned, let's say.
Yeah, it's a good question. So I'd say like we invested in Terra back in the summer of 2020, and we invested like when it was really cheap. I forget the exact valuation, but we invested about $2 million, so it was actually initially a pretty small position for us. Um, and then if you kind of like fast forward 2021, they started getting a lot of traction. Um, and then later in 2021, I'd say the problem is they started like um, really aggressively like subsidizing like parts of the DeFi stuff built on top of it. And I think they subsidized it so much that like when the prices of stuff started to fall, um, it really kind of like basically death spiraled in a kind of cascading set of failures. From an investment standpoint, actually, I just pulled it up. So our initial investment was about 1.7 million, and we traded it basically just like de-risking, pretty steadily over the course of like 2021 and then part of 2022. Um, and we ended up turning the 1.7 into about 170 million for like LPs at kind of at the end of the day. But I'd say there is, a couple big lessons there. One is that we were too at parts of it. I'd say we were too aggressive. Like going into May of 2022, I'd say we had too large of a position on in it. Like we hadn't de-risked as much as we should have, I would say. Even though like the overall return on the investment still 100x, I think we still probably could have de-risked a bit earlier going into May. And then I think the other risk is, or the other mistake is just like that. I think if we had kind of paid closer attention to like what was happening on chain, like with on chain analytics, we might have been able to see like what was going on a bit more with like the actual subsidies and stuff, and they've been able to exit uh, more of the position sooner. But that's kind of the story there.
Have you developed your own software to look at all the on-chain analytics, or using some? I'm curious because I assume that's a big part of what you're doing, because you know blockchain, everything's public. You can see everything that's happening, uh, all the trading that's happening, all the movement of tokens. Um, did you build your own proprietary tools? Have you done that?
Not on that side. There's pretty good stuff that like people have built like specific startups for. So there's like if you're looking for like high level kind of like financial metrics, token terminal is really good for that. If you're looking for like data on like um, specific smart contract stuff, Dune Analytics is good for that. And there's a handful of other kind of like similar projects that are good for that sort of thing. The problem with stuff like Terra, as an example, though, is like you either like those startups don't really exist because it's like newer, and if you build it in house, like you could do it, but then like that's all you spent 3 months on, and then like you probably have a bunch of other problems that you should have been solving instead. And so that stuff I would say it's really good for the Ethereum ecosystem. And there's a lot of just like off the shelf stuff that you can subscribe to, and then kind of like you know generate queries in a way that like gets you the data you want. It's like one thing is if you go to like Dune Analytics and go to their like dashboards that like the public has made, sometimes people are collecting the data incorrectly, and so like you need to massage the data to actually get to like what reality is, um, stuff like that.
Gotcha. So I have a couple more questions around your perspective on traditional finance, knowing where you are, where you're sitting in the finance world. Um, does it end? Does everything go this way? Does everything go decentralized? And what's kind of your sense? And obviously, I think there's a perspective that after the financial crisis, there was a loss of faith in financial institutions, and there's a sense that they're not there to protect us per se. There's a lot of self-centered self-dealing happening, which you would think the world of crypto is supposed to solve a lot of that. But what's your perspective on traditional finance getting disrupted by this technology?
Yeah, I mean, I think if you look at traditional finance, they have there's like two things that traditional finance has, maybe three, that are like actually useful. One is they have a customer relationship. Two is they have like the regulatory licenses in moat, and then I'd say those are kind of the main things. The rest of there's a lot of drawbacks, right? Like you have like these banks that have huge office footprints, and whether it's like their actual offices, whether it's like their bank branches, it's just a huge cost center for the customer, which means you're earning less on your money. Um, and the other problem I'd say is one of the two advantages that I listed, the licenses and stuff, is also a big cost center, right? And a lot of the reason why they have these positions is because they've sort of done it via like regulatory capture. Like the banks have huge lobbying arms. There's a reason why it's been forever since the U.S. actually like approved a real bank charter. There's always like startup banks that have like partnerships with other banks, so they have like these kind of light things, but actual real charter, I forget the year, but it's been a long time. And so I think what happens is long term, I think like this tech disrupts them, and I think there will be. It's not going to destroy all of them though. Like some of them will still be relevant and stay around because of their customer relationship. like I think there will be some banks that long term kind of like plug into this as a UI layer. You have to re-architect your business, right? Like you have to shift your business from the same way the New York Times shifted their business from being a business that primarily hands out newspapers that are made of paper to one that has like really good like digital content. Like you'd have to do the same thing on the bank side. Like banks will compete 20 years from now. Banks will compete based on the UI layer and like what the experience is like for the user, and then plugging into all this stuff under the hood. Um, I don't think they'll be competing based on like you know um, like the regulatory moat stuff. I think starts to fade as this tech becomes more relevant, and also a lot of the reasons why those regulations exist starts to fade. There's definitely room for regulation in areas where it makes sense, but a lot of the banking regulations that as they exist today, um, you can kind of comply with them via software very easily. And there's some that are much harder and much more complicated problems, like the problem of how do you do KYC AML. That's like a really messy problem. But things like capital requirements and stuff are pretty trivial to do in code.
Yeah. So, but don't you think that, I mean, obviously the government's starting to regulate crypto, and the question is whether they bring all the regulations that they brought to the traditional finance world into crypto. So will the government play a heavy hand in regulating crypto in the way that it can't be, it has the same properties and principles? The regulatory moat gets created. What's your sense?
Yeah, I mean, I think like one thing that's interesting here is if you look at like American, like let's just use America as a simple example, so we don't have to deal with all the different countries. But if you think about it, the U.S., right? I forget the exact numbers, but it's something north of 10% and something probably south of 20% of Americans own crypto. And if you look at things like that, that a very sizable percentage of Americans do, it's really hard to like permanently like constrain them a lot because it makes people upset. And one example of this is like, yeah, it took a long time, but if you look at kind of like the liberalization of like marijuana policy and law, right? Like, like you can literally like go anywhere, any major city in the U.S. and whether it's like CBD or actual like marijuana, like you can just buy it. And like 20 years ago, that was basically unheard of. And so I think like if you look at it from a financial standpoint, this is sort of that, except far more people in percentage terms own crypto than use marijuana in the US. And so, like, if you look at like from a regulatory standpoint, there might be some regulators who want to do things, but and some of those things that they want to do actually make sense. To be clear, right? I'm not like anti-regulation. I just think it needs to actually make sense with the tech. But then if you look at Congress, they're going to have all these constituents who don't want their constituents don't want people who own crypto don't want it to just be like de facto captured by the banking system, right? Like that's like the least interesting outcome, and also would probably make most of their investments go to zero or near zero. And so like there's this huge incentive from the standpoint of Congress to not let the regulators get too heavy-handed in how they go about regulating the space. And so I think what you'll actually see from kind of people I've been speaking to is that I think you'll see eventually Congress start to kind of pass some legislation to try to basically get ahead of the regulators. Um, doing things like passing legislation around like rules surrounding like stable coins. Like if you're USDC, where do you have to store your money?
Where's
Eventually, I
the
think
assets?
they'll
Yeah.
eventually get to things like DeFi. Like if you're a developer building a DeFi protocol, like maybe you need to like have an audit or have like I don't know like it's far out there, but I think that's where it ends long term.
What's your perspective on when you think of the change in crypto over the last 10, 12 years since Bitcoin in 2008 to today, and the community around it, and obviously the people have changed from like it was like sovereign individuals. Now it's I call them it's more like community of sovereign people, but they're part of a community, even though they've always been a part of a community. They don't have that sovereign individual feel as much, I think, as the beginning. Like we're hiding from the government, and like John McAfee type of person. It seems like it's shifting, but what do you think about the culture side of it? And is it shifted for the better or for worse? Where's it going in your perspective? It seems like all this is interconnected into the success of these platforms.
Yeah, I mean, I think it's definitely evolved a lot since when I got into the space. Just like out of like necessity, and also just out of like statistics, right? Like if you're hearing about like this money that someone created that's not of money created by a government, and it's like this weird thing on the internet that you like mine it with your processor or your GPU. Like you have to be kind of weird to come across that. And like as it starts to get adopted, you know, the community gets less weird, it gets more diverse, the culture kind of shifts. And then like I think the next big shift in culture was like when Ethereum came out, because then it brought in this whole group of people who weren't just like monetary policy nerds. Like the early kind of community was a lot of like gold bugs, people who like kind of didn't like the way the Fed was doing things. With smart contracts, like with the advent of Ethereum, with smart contracts, you then open up all this universe of people who like want to do stuff in finance, who want to do stuff with like video games and like Web3 stuff. Um, and I think as that community has gotten larger, you now have a very wide range of people, all the way from like the most right wing person you could imagine to the most left wing person you could imagine, who are all like using this tech and building in this space. And it's a pretty wide range of viewpoints. And I guess like to answer your question about is that good? Definitely. Because like if you think about like the thing that's the biggest risk to the tech, I don't think it's actually a software issue anymore. 3 years ago I would have said scaling. At this point, it's just like the regulatory environment and like that Congress like gets it wrong, messes it up. But if you have a very wide group of people using something, it doesn't really become as much of a partisan issue. Like crypto is something that Democrats care about and that Republicans care about, and that people who hate both of those terms care about. Which is nice. You don't have that many of those things these days.
Yeah, that definitely doesn't have one group of it, the left or right or woke or not, whatever it is, owning the larger portion of that. I guess one of the things that we all thought about was that under inflationary, um, what's happening with inflation, that this would substitute out for gold. Bitcoin would substitute out for gold since it's not printed by the government and can't be, over created, and it has an endpoint to it of how many coins could be actually minted. It didn't seem to play out that way. From my perspective, it played out like tech. It played out the tech market, which my stock's part of. We all went down pretty hard, and crypto's gone down pretty hard. It feels like it's correlated to tech investors, not to people who normally buy gold and they're going to use this as a gold substitute. What's your perspective? And why do you think it didn't become a hedge for inflation?
Yeah, I mean, I think a couple things. I think one is that the universe of people who own crypto now is much larger. And so like a lot of them own, tech stocks and stuff. I don't really for the most part. But a lot of people do, especially a lot of the larger kind of like institutional investors. And if you look at like what people are gonna like, de-risk when the market's like, when the sky is falling, quote unquote, people sell like their most volatile and most liquid assets. And like you look at crypto, well, it checks both those boxes. The crypto markets as a percentage of like um as a percentage of float, like the daily trading volume is far more liquid than almost anything else out there. It's on par with like Apple stock in percentage terms. And then volatility wise, it's also really high at the charts. So like if you're like a traditional macro fund, you got 5% in Bitcoin, you want to de-risk. You tell the traders de-risk your most volatile stuff, and they're going to go sell your Bitcoin. Um, and so I think that's part of it. I also think part of it is that like if you look at Ethereum, etc., it does look more like tech. Like you could envision like ETH being used as kind of this monetary unit or something, but like the way it's getting priced is as a tech revolution with finance. And then I guess the last thing I would say is if you look at like the if you look at like the correlations between crypto and traditional assets, you know I think it tends to kind of like markets are like forward leaning, right? So like when inflation was low and the Fed was doing a bunch of aggressive monetary policy stuff, crypto did go way up. And then once inflation actually like got here, and then the Fed started tightening, it came back down. So I think there's also some element where it leads inflationary movements as opposed to actually goes up during them.
So my last question is, as a as an entrepreneur yourself, you know, what do you and being one of the leaders of your company, um, what's sort of like your basic philosophy around culture, or how you run the business, or what we all, I have one, like never quit, never quit, especially on your bad days. Like you got to work through it, because I've been doing this for 27 years plus. Kind of what's sort of a basic philosophy you have about building a business as a startup, growing it, stuff like that?
Yeah, I definitely agree with that one. Like I think like one I would say is like, like don't say like why something's not possible. There's always 1,000 reasons why something's not possible, but like there usually is at least one way you can figure out how to actually do it. Um, I think also like culturally, like, I like people who are like pretty honest, like upfront, people who kind of like take initiative, move quickly. I think like also like kind of like low ego but high passion. Like people kind of like tend to conflate the two. Like I'm totally happy to have like a super passionate debate with someone about something. Um, but like I think like some people like assume that means that it's like an ego thing, but it's actually not. Like you especially see this with engineers. Like if you walk into like an engineering meeting, you know, you might see two engineers really rigorously debating something. And if you brought somebody who wasn't an engineer into that meeting, they might think that these two people hate each other. But actually, like they're like best friends. And they're just like trying to get to the root of like the actual answer, which is something that I really value a lot. And then I would say the last kind of philosophy thing I have is like on hiring. Like the thing I've noticed the most is like when you have people who can like do three things. Elon Musk actually sent me an email about this recently. Like they can either like solve the problem head on. If they're blocked, surface why they're blocked, or if they don't understand it, like they don't understand their task, they ask for clarification as opposed to just like trying to like guess what they should do. If people can do those like three things, they generally are very effective. If they can't do any of them, you're generally very ineffective. And if they can do like two out of three, like they might work or they might not. And I think like thinking like that is actually really useful. It's like it sort of makes people accountable for things. Like the thing I really don't like in a culture is like when people like just kind of complain about a bunch of problems. It's like that doesn't make sense. Like what you should do is like solve the problem yourself if you can. If not, surface it to the person who can solve it. And then like that's how you like iterate and move forward. So like those are kind of the values that I say are really would say are really important.
Yeah, I call it the parable of the cow in the ditch. Someone once told me that, when there's a cow in the ditch, what do you do? It's a question I ask sometimes. At a leader, like when I'm with my leaders, we're having a problem. Like, there's a cow in the ditch. What do you want to do? And I said there's three people who were standing around the cow. One was complaining of how bad the cow is in the ditch, and why did this happen to us, and God, we suck. The other person was trying to point to the cow, it's fat, and why did it get so fat, and if it wasn't for so and so dug the hole. And then I tell the story. I said, well, what's the right thing to do? Who's got the right answer? Which one of these three personalities? And I always say, like, it's none of them. It's just get the fucking cow out of the ditch. Like, get the cow out of the. Then he can analyze why it got in the ditch. Then he can make sure you don't ever have a cow go in the ditch again. But if the cow dies in the ditch, all the other stuff doesn't matter. So I guess it's the same
Right.
sort of thing. Just get the cow out of the ditch, right? So
Yeah,
Joey,
exactly.
thank you for being on the show. I think it's really great. You have a newsletter I think you guys put out. I saw also. Do you and so I think it'd be great if anyone follow Joey, one of the true professionals in this industry. That's a new industry, obviously, especially around what you want to invest in and all that. And once again, I want to appreciate you coming on the show and sharing your expertise with us and with all the listeners. Thanks.
Awesome. Yeah, thanks for having me.